Okay, so thanks for joining our meetup group for real estate investors. We'll be looking at investments in the US tonight. So just a brief disclaimer. We're presenting this on an information basis only. It's not intended to be taken as tax, accounting, or legal advice. And also be aware that this is subject to change at any point without notice, given that there could be a court case tomorrow, the government could announce a new plan tomorrow, and it could change what we talked about, but this is based on the currently available information. Okay, so we're going to talk a little bit about reporting requirements, get into some structuring, cover some other issues, and deal with your questions. As always, please just throw your questions in the chat and we'll go through all of them at the end of the presentation. So we're not going to cover every possible investment structure. It can be quite confusing for everyone if we did that. So we'll just cover 3 or so. And we're not going to get into a lot of HST. We're not going to talk about short-term rentals. We're also not going to talk about the requirements that American dual citizens have to deal with. So a little bit about me. I've been a professional accountant for more than 30 years. The last 10 or so of which have been focused on real estate investors who invest either in Canada or the US, the latter of which I call cross-border investors, or CBI. And I work with American CPAs to deliver comprehensive solutions for people that do that cross-border investing. So I provide assistance with the US investments, help you set up any corporations or other structures you need, provide operational consulting, as well as tax planning and tax return preparation on both sides of the border. So just a little bit about me. My international practice has increasingly become focused on real estate investors who invest at all levels, from single family homes to apartment buildings. I also hold a CFO position with a local home builder. I own a nearby condo, and right now I'm looking for an apartment building in Texas, initially in the Houston area, simply because of the greater returns that are available. So the plan to meet is to meet once a month on the last Thursday of the month. And I'll be delivering most of the content, perhaps with the occasional guest speaker. And we'll address all manner of real estate issues. And I'm happy to take any suggestions you have. You can throw those up in the chat or just bring them up at the end. If you have more detailed questions or have something you'd like to discuss one-on-one, you can go to this link and it will enable you to book a complimentary half-hour session with me. Also, just put that in the chat for you as well. Just give me a second here.
Already did it, Michael.
Okay, thanks, George. And so we have appointments available on that hour-and-a-half hour tomorrow from 2 to 4, and on Monday from 10 to noon. If those don't work, then just email me and we'll arrange a mutually beneficial time. Okay, so foreign asset reporting. This is required once you hit the $100,000 cost level on your assets. This is the name of the form. It's called a T1134. It's got a big long name, but T1134 is fine. There's a similar form if you own property as an individual, called T1135, with the same $100,000 starting point. And the one we're going to be talking about is a T1134, which relates when you're holding property through corporations as opposed to in your personal name. So it's been around for a while, 18 years now. And this return, it's best to be filed with your tax return, but you have up until 10 years after your corporate year end. So almost every person has a tax year end of December 31st. I'm sure you're all aware of that. Once you set up a corporation, you're free to choose essentially any day of the year to end your corporation on. As a practical matter, it's going to be the end of 1 month or another. And it's would be due 10 months after that. So if you had a December year end, you'd have to file this return by the end of the following October. So the major item we want to just highlight here is what has to be reported. They call it specified foreign property. Now there's a whole long list, which we're not going to go through in any detail. There's only 1 or 2 items that I wish to highlight. The most obvious being, of course, real estate. So they call that tangible property situated outside of Canada. That's the major item of interest for our purpose here. Also includes shares of capital stock. So if you own shares in a US company, as an example, or a European one for that matter, you'd have to factor that in when you're calculating what to report. This is an extremely complicated form, and you're going to want to have help with it for sure. So one thing to note, though, what it does not include is if you have a business in the States. We talked briefly last time about an active business. An active business is essentially anything that's not collecting rents, royalties, interest, or dividends. So you have some sort of operating business, then that property is excluded. The other key one is going to be a personal use property. So this is your stereotypical vacation home, which is typically in someplace warm like California, Arizona, Nevada, or Florida, those kinds of places. So those are excluded, provided that you use it at least 50% or more for your personal use. And you can also factor in people in your immediate family, basically. The other big exclusion is if there's not much going on in that foreign company, it's called a dormant or inactive foreign affiliate. So you don't have to report this either, provided that there's less than 100,000 in gross receipts. Now, it's important to note here that that's not income, because people think, well, my foreign corporation, it's just holding shares, let's say. There's no income at all. It also factors in loans. So that's one thing you got to be careful of. So if there's less than 100,000 in income and loans, and your assets have a fair market value of less than 100,000, so that's what it's worth on an open market to an independent third party, it's less than $1 million, then you don't have to report on that one either. So now we get into why this is important. There's a regime called Foreign Accrual Property Income, or FAPI. I know it's a horrible acronym, but I didn't invent it. It's just what we're stuck with. And basically, this came about because the Canadian government, in its infinite wisdom, decided it does not want you to earn investment income, like most particularly rents and interest, outside the country and not pay tax on it. So that is their thinking, because people understand, well, if it's in my personal name, then obviously being a Canadian tax resident, I have to report my worldwide income for the year. Doesn't matter where it is, doesn't matter if it's left there or brought back, there's no other place to report it, right? So you'll report that. But if I don't need the money, I'll just set up a corporation, let's say in the States, and I'll just accumulate, let's say, rental income there until I get enough money to buy a second property. I'll have a nice down payment. And then I'll have US assets, so I can most likely get a mortgage and get this second property. And then that allows me to get the third property faster and faster. Well, as I said, the government decided they didn't like that because they couldn't tax it. And so they set up these rules. So the first steps is simply, is it a foreign or non-resident corporation? If it's yes, you have to determine if it's a foreign affiliate. So this is just the hierarchy of how you go through it. And basically, if you own 1% or more of any class of shares, directly or indirectly, so directly means you're the listed shareholder, indirectly would be you own a corporation or other entity and it owns those shares. So that's the indirectly part of it. And the total that you own, along with essentially the members of your family, is at least 10%, then you're caught by the foreign affiliate rule. So if you own 1% or 2%, let's say, but collectively you as a family own 9%, then you're not caught by this rule. Realistically, you're going to own a substantial percentage. It's often 100% or 50% or 33%, depending if you have other shareholders. So you're going to be caught by it in all likelihood if you've set up a foreign corporation. So we decided you're a foreign corporation. We decided you're an affiliate because you have the 10% or more as a family. Next, are you a controlled foreign affiliate? So as you may have guessed, they've had a lot of court cases on this, and there's one in particular that is of great value on this point called Duha Printers, where they talk about de jure control. So de jure simply means legal control. But that case also talked about effective control, and that's determined by looking at things like the share register, any unique powers mentioned in the shareholders agreement, and so on. So basically, any of the important documents around the corporation are looked at to see if you have that control. If yes, that makes it a controlled foreign affiliate. And the passive income, so the dividends, the rents in particular, the interest, royalties, things like that, all those sorts of passive income will be taxed in Canada. And here's the key point: regardless of the amount transferred to Canada. So what that means is whether you bring back 0% or 100% of that income to Canada, you will be taxed as if you brought back 100%. And that's just what this is saying. So you'll be taxed on it, even if no amount has actually been, the word, you know, we have fancy words for everything, of course. It's repatriated. So if regardless of the amount repatriated, you're taxed on the entire amount. Now, there's one rule that if it's below a certain level, then you're exempt, and that level is $5,000. So if you just have a single property and you know you're clearing a few $100s a month, let's say $300 a month, that's $3,600, you're going to be below this. So it's as you add the second property where this is likely to kick in, or third property, depending on your model. Now, what some people get a little bit confused in is if they're fixing and flipping in real estate. So you're buying a property, repairing it, reselling it at a higher value. That's what we call active business. However, when you're looking at an active business for a foreign company's business, the rules are different. And that a lot of people miss. And so the important thing is, in the case of people who do this fix and flip in the US, that will be considered investment income, even though it's not considered that in Canada, which means you're caught by FAPI. And there's just the references. Specifically, there's a reference to real property, which is real estate. And some corporations are in the business of actually building and selling homes. So that's definitely active in Canada. However, for the purpose of the FAPI rules, that income will be considered foreign accrual property income, because the purpose of the business is to derive profits from the sale of real estate. And there's only one exception here, which is when you have more than 5 full-time employees. While possible, that's highly unlikely, because you can run a pretty big real estate operation with only 4 or 5 people. So it's not helpful for most of us. It's also important to know that independent contractors don't count towards those 5 bodies that you need to be exempt from the FAPI rules. Now, the reason why I recommend corporations for many investors who are investing in foreign countries and don't want to bring back all the income is because of this slide here. The way the FAPI tax is calculated, there's just the mechanics of the form. There's a relevant factor. And for corporate shareholder, the factor is 4. For an individual, it's 1.9. So obviously slightly less than half. So what does that mean? The end result is that for corporate shareholders, there's generally no net FAPI in Canada, provided you pay tax at the rate of at least 25%. For individuals, however, you need to pay more than 52% to avoid paying additional Canadian tax. Right now in the States, the federal income tax rate for corporations is 21%. Most states over 40 have a state income tax. So provided that's at least 4%, you're at 21 plus 4, gets you to 25. You won't pay any additional tax in Canada because you have the corporate shareholder. Which is why I recommend that people who are investing in the foreign countries and don't want to bring back all the money, go with the corporate structure. So you can get an absolute savings here, not just a deferral. Because when you actually pay the money through, there's a dividend. As a dividend, you get to send that up to your holding company free of Canadian tax. And that's standard when you have a corporation that's connected to you. In other words, you have ownership, 10% or more, and it pays you, you being your corporation, a dividend. You don't pay any additional tax if you keep that money in your Canadian corporation. And it works the same if you have multiple Canadian corporations. Then if you do pay it out, there is additional tax, but it becomes a favorable tax treatment because you'll pay less than 40%. I believe it's just under 38 to be a bit more exact, versus if you paid it out as an individual, directly to an individual, the top tax rate is 53%, 53.5 again, to be exact. So that means that by going through that system, you can actually defer as much as about 15% of the tax. Okay, so now onto the more interesting stuff, but I think it's important that we cover that because not a lot of people know about that. So I'm going to discuss 3 possible structures as we see our arrows appear. Structure 1 has 3 corporations. Structure 2 incorporates a trust. And structure 3 is limited partnership. There are, of course, numerous variations on these, but for investment purposes, structures 1 and 3 are by far the most popular. And structure 2, as we'll see, can be useful if you're buying that vacation home that we talked about. Okay, so we'll go through these structures in a bit more detail. First structure has a Canadian corporation, which owns a USC corporation. Unlike in Canada, where we essentially have one type of corporation, whether it's federal or provincial. In the States, they have several different types. C corporation is the most like our Canadian corporation. So then this C corporation, which is often in Wyoming, is going to be the sole member, which is the same thing as shareholder of a limited liability company. That limited liability company is going to purchase the real estate. So limited liability companies are sometimes referred to as a pass-through entity or a disregarded entity. So what that means is any income that's earned by the LLC will get passed up to the corporation above it, which is to say the C corporation, and it reports the income, which means there's only one tax return to be filed here, which is the C corporation's one. Now, as we mentioned earlier, the federal tax rate is 21% right now. The full tax bill will depend on the state. You know, it varies from 0 up to, I think, New Jersey is the most expensive tax rate at 13.5. You can then move money from the USC corporation to the Canadian corporation just by paying a 5% withholding. And if you keep it in the Canadian corporation, that's the end of it. There's no further taxes. This is what I call my triple C structure, just for 3 corporations. It works well for most investment properties, but it may not be recommended if you're going to bring back all the money, because then you don't necessarily need all this extra complication. Yeah, so that's just talking about the 5% withholding and no additional tax. So the second structure is going to be for the vacation home. So the Canadian resident sets up what's called a bear trust, and that's just the very, very simple trust which owns the real estate. The bear trust does. Works well for personal use property, the vacation home that we've been talking about. Obviously, you're going to want some good insurance coverage. By adding the trust to this structure, you get some benefits in that it addresses these following issues. Mental incapacity. So if you owned it directly or perhaps with your spouse and one of you was deemed mentally incompetent and you don't have your powers of attorney in place, which would have to be set up, frankly, in both countries because they don't recognize the Canadian documents in the States. You then have to get what's called a guardian appointed, which is a whole lengthy legal and administrative process, which you would avoid by having the bear trust, because a trust can't lose its mind, if I could put it that way. Also addresses community property concerns. You know, perhaps you wanted to leave it to your son or your daughter, but not necessarily their no good spouse. So by keeping it in a trust, it would prevent that from becoming community property. Also address probates. A trust can't pass away, and therefore it doesn't have to go through probate once to, you know, at any particular time. There's a personal use benefit if you own it through your own corporation, which has to be reported as taxable income to your corporation. Whereas if it's a trust that owns it, that doesn't apply. So a little bit more about a bear trust. Bear trust has obviously a trustee, but they have minimal duties. All they are required to do is to turn it back to the beneficiary once they're instructed to do so, and to deal with it as the beneficiary directs. So the beneficiary, for example, may instruct them to sell the property. For income tax purposes, bear trusts are ignored. So whoever the beneficial owner is, so the beneficiaries, they're treated as the owner of the property, and they would report any income on the sale of that property. Now, in the United States, a bear trust be considered a revocable trust, which means any income will flow through to the beneficiaries. So just like in Canada, treated the same. Probate can take over a year. It's important to note that if you try to do that by dealing with it in your Canadian will, that doesn't do anything for you in the States. So you have to go through that procedure. And here's just some sample probate fees. This is based on the market value of the property, which is actually quite a bit higher than our probate fees. And the bear trust, unlike other forms of trust, like you may have heard of a trust set up by a will, which is called a testamentary trust, every 21 years, that type of trust has to dispose of all its capital property. That doesn't apply in the case of a simple bear trust. It also provides asset protection from creditors because the trust is the one holding it. Now, the US have estate taxes. We don't have that in Canada. We have a different type of taxation, which is upon a taxpayer's death, all of their assets are deemed to have been sold at whatever the fair market value is. And any tax is then assessed on that amount. In the States, they assess based on the value, and there's varying amounts that are available. The last I saw it was over 11 million for a couple, but that is of course subject to change, and President Biden's already made noises about trying to do that. Whether that happens or not, who knows? Unlikely, I would say, but you don't know. Also, capital gains for a trust is typically taxed at a lower rate than corporate capital gains. And US banks loan money to trust for mortgages, so that can be quite helpful, particularly if you want to buy a couple of vacation homes, different places. Now, the same person can be the person who sets up the trust, which is called a settlor or grantor, can be the beneficial owner and the trustee. So other types of trusts, you don't want that because there are negative tax consequences, but it's okay for this type of simple or bare trust. And they can be the beneficiary as well. Spouse can also be a trustee, and the beneficiary can do whatever they want with the property. They have what are called long-term capital gain rate, which is applicable once the property is held for at least a year. Not exactly what I would call long-term, but that's their rules. And you can revoke or amend the trust if need be. There's no annual filings if it's used as a personal residence, which is very good to know. Save yourself a lot of paperwork that way. And there's also no CRA filings. So there's no filings either side of the border for that. And as we talked about, it's protected from the reach of the creditors, provided the property remains in the trust. Now, any distributions to the beneficiary would be tax-free because tax is paid at the level of the trust. So you distribute, in other words, what's left over from the income, if there is income, after paying the tax. You can also transfer property to a trust by way of what's called a rollover that works on both sides of the border. So this would apply if you already own the property and then want to set up the trust after the fact. That can work as well. So we talked a little bit about personal name corporation. The other main form of ownership is the limited partnership for investors. Beyond that, there's the LLC, and some people may have heard of land trusts, which we'll discuss very briefly. So in terms of where to set things up, often people will set up an entity in the state where they're buying. So let's say you're buying in Florida, you'll often want to set up a corporation there. But especially if you're going to invest in more than one state, you should look at setting up in a state that has better laws regarding things like income tax rates, asset protection, disclosure required, fees, and so on. But just know that if you do have a corporation set up in another state that's doing business in a second state, that's actually considered by that second state to be a quote foreign corporation. And there's a small fee that's required, but that's just standard. So why were people looking to not own it in their personal name? Well, asset protection is definitely a key consideration. As I'm sure you're aware, they're much more sue happy in the States than we are in Canada. A lot of that is driven by the healthcare system being not, well, you having personal responsibility in most cases for your healthcare costs, even if you have some coverage through your employer. Also, limitation liability to other creditors, lenders, tenants, contractors, etc. Also helps to maintain some privacy regarding the ownership of the property, which may be a concern for you. Also simplifies transferring of ownership because you're moving around shares or partnership interests as opposed to real estate. Anytime you move real estate, there's a possibility of land transfer taxes. Now, not every state has land transfer taxes, but the ones that do, obviously you'd prefer not to pay them if you're simply shuffling the ownership. It makes estate planning quite a bit easier. So the goal obviously is to minimize the negative tax consequences. So if it's a personal name, which is individually or through a general partnership or a joint venture, which is the JV. The latter two approaches, the title remains in the name of the partners or joint ventures, unless you're using a corporation to hold that interest, which is also possible. So if it's in your personal name, it's an unlimited liability situation. If you're subject to being sued, then the creditors would have recourse to all of your assets. People are interested in this type of ownership though, because the income is taxed at their personal rate, which could result in a tax savings potentially. And obviously, if you don't have to set up additional companies, you're saving on the administration and maintenance costs. It's often easier to obtain financing. And you just buy more insurance to cover off the personal injury and property damage issues for rental properties. Often people will start with this, or at least consider it if they're just buying single family homes. Now, for greater risk real estate businesses such as apartment buildings or multifamily, commercial properties, if you're fixing and flipping like we talked about, that's when you want to seriously look at using a business entity to limit that liability. Just to touch on wills, it's likely that the will require to be probated in jurisdiction where the property is located if the owner dies. So it's not just a question of probating things in Canada. If you own foreign assets in your personal name, you'll have to deal with that as well. General partnership, virtually no one's going to be using, but I just include it to contrast it with a limited partnership. So a general partnership is one where two or more parties act together with the intention of making a profit. So all assets remain in the name of those individuals, which means all of your assets would be exposed if there's any sort of litigation, which is why you wouldn't have this. However, an income is taxed at each partner's individual tax rate. Joint ventures are certainly something that people look at, and usually that's more of a short-term thing where there's a specific project. So maybe you decide we're going to buy a building, we're going to operate it for 5 years, and then we're going to sell it. So there's a formula that they're going to split the revenue expenses and they're each joint venture is going to retain title to their part of the property. It's very, very important, whether it's in Canada or elsewhere, that if you do a joint venture, you need a joint venture agreement, because that needs to address each joint venture's responsibilities, the exit possibilities. So buyout, you may have heard the term of shotgun clause. And all that means is, let's say there's just two joint ventures. The first one says to the second one, I'll buy you out for X dollars. And they have to offer a fair price, because if they try to lowball the seller, the other joint venture, the joint venture, because of this, as I said, it's called a shotgun clause generically, they can turn around and buy out the first person at that same price. So that's why they have to give them a fair price. However, if you don't have an agreement, you won't have that ability. And that works best for these one-off type deals. So you may execute a series of joint ventures, but with different people every time. Now, we'll look at a corporation. You have your liability limited to the assets of that particular investment, meaning your personal assets are safe. You can transfer shares fairly easily. There's no change in the title, because it's the same company that owns the property. Who owns that company will change, obviously, if you sell your shares. And again, a little bit more privacy if that's an issue. If you do it incorrectly, though, this may result in less favorable tax treatment. So similar to the joint venture, if you have multiple parties involved, you must have a shareholders agreement to deal with those same issues of who's doing what, how you resolve disputes, the various exits, so buyout, departure, what have you. Now, obviously, this is a separate legal entity, so you have setup costs, you have annual filing fees. Could be a franchise tax, which is, for our purposes, roughly equivalent to a state income tax. Limited partnership will have one general partner. There's no need to have any more. And that's always a corporation to limit their liability. Why? Because a general partner in a limited partnership is just like a regular partnership. They have unlimited liability for any debts, obligations, lawsuits, etc. of the limited partnership. And that's often run by whoever is basically running the deal. You'll then have one or more limited partners, and their liability is limited to whatever they have invested, provided they don't take part in the management of the limited partnership. So essentially, they're just going to cut checks and not get involved much beyond that. Again, you're going to have a partnership agreement that sets out the duties, and those few major decisions, such as selling everything, which will require input from the limited partners. So again, it's pretty good privacy on ownership here. Only the limited partnership's name will appear on the title. In this case, the investors will get pass-through tax treatment, which means the income is taxed at the investor's rate, whatever that may be, which is why if you want to invest in your personal name, this is how you would do it, through a limited partnership. Because you get presumably good tax treatment, but you still have the benefit of having the general partner with all the legal liability. It's generally used for rental properties where you're having, this stereotypical silent investor. It can be used for any business purpose, but given that we're a real estate group, obviously that's our focus. Again, unlike a general partnership, this does require registration. So there'll be some costs to both set that up, file annually, and fill out whatever information returns are required by that particular state. LLCs, which stands for Limited Liability Company, are extremely popular in the States, and they're held directly by the US residents. However, you don't want to ever hold an LLC directly, which is why when we looked at it earlier, we had an intervening C corporation. The reason for that is CRA looks at that as a corporation, whereas the IRS looks at it as a pass-through entity, which means they expect in probably 99% of the cases for people who hold the LLC directly to pass the income through to themselves so they can be taxed as individuals. That's the expectation. That doesn't work for Canadians because you get a tax credit. You pay tax as an individual on your US personal tax return, and the Canadian government says, oh, hold on a second, you can't claim that you paid tax at the personal level because your limited liability company is deemed to have paid that tax. So basically, just never own a limited liability company directly if you're a Canadian resident. That's the takeaway. And that we just talked about, they get to pass through. And that's why if you talk to an accountant or an attorney who's not versed in the Canadian consequences, they'll almost exclusively recommend that you get an LLC, and that's not what you want. If you're going to have multiple people that are owning the property through an LLC, you will need an operating agreement. Again, so you see a common theme here. Anytime you involve other parties in whatever entity, be it a partnership, limited partnership, LLC, corporation, you need an operating agreement to set out who does what. And again, how to get out of the deal. Laws are pretty flexible regarding operating agreements. Pretty much anything you agree to with your other parties in the LLC are fine legally. Now, there are, again, some setup costs, annual filing fees, etc. Just going to briefly touch on land trusts. Some people may have heard of those. So we talked about bear trusts earlier. So there's similar things here. It's going to hold legal title, but there's a beneficial owner which controls the property. It's not used all that much simply because only some states allow it. So it does make passing it through an estate much simpler though, because again, you're transferring an interest in a trust. You're not transferring property. That would likely then mean there's no land transfer tax if that state has that particular tax. One thing though, people will often promote this as being very useful for anonymity. That can be the case, but in order for that to apply, you have to take title to the property, name the trust, which you would do using a nominee trustee. So you can't be the trustee of your own trust in that case. And here's the kicker. You have to purchase the property for cash. If you don't do that, then your name will not be all that private. Again, there are some administration costs. You have to pay annual fees. They're not great asset protection because they're not irrevocable, which means you can transfer the asset back to yourself. That's what it means. If a trust is irrevocable, the asset's gone forever. You don't own it from that point on. If it's not irrevocable or revocable, then you can just say, give it back to me. So a few other issues to consider when you're setting up in the States. If you're going to own property, as I said, in more than one state, you're probably going to want to shop around for a state which has more favorable or flexible laws. Current favorite for a lot of people, myself included, is Wyoming. They have very good asset protection laws. Their fees are quite reasonable. And just in the last few years, they've fully computerized their operations. That used to be the one drawback. So when I was setting up entities about 5 years ago, we didn't go to Wyoming because it just took too long to set up. But now I've had them set up in as little as 2 days. So that's perfectly acceptable, I think, for just about any purpose. You may also want to consider, if you're raising funds in a bigger project, you could actually have 2 limited partnerships, one in Canada and one in the States, and that will reduce some of the complexity of raising the money because you don't have cross-border securities law issues. You will have to deal with, in Ontario, it's called the OSC, Ontario Securities Commission. In the States, it's the SEC, which is a federal body that applies in every state. But you'd only have to deal with the local rules, so to speak, if that's how you do things. So some other issues. In terms of rental income, there's a form called 1040-NR, and that's how you actually report your US rental property income. There's a different schedule called Schedule E. This is for information purposes. My American colleagues would do all this for you, but just to give you some concept of what's involved. Now, net rental income is defined as gross rents less the typical expenses that you're probably aware of, such as property taxes, mortgage interest, repairs, insurance, management fees, utilities. So there's only one significant difference, and we're going to touch on that shortly. You want to get taxed on the net rental amount, because if you don't, then you'll pay on the gross, which is almost always going to be much higher. If you want to pay your tax on a net basis, then there's a form to fill out, which is the one you see there, the form W8 ECI. And that gets you out of that 30% gross withholding. Now, interesting enough, this doesn't go to the IRS. This either goes to your tenant if they're paying you directly, or to a US agent who would be collecting the rent and then eventually paying you your share. Now, here's the one significant difference between US and Canadian rental income. In the States, depreciation is a mandatory deduction, which simply means there's no tax planning involved. You have to take it, and you have to take the full amount. This depreciation is at a different rate than in Canada. which will create a difference in the net rental income in the two countries, meaning you may have no rental income in the US to report on a net basis, but you actually have income in Canada, because after the first couple of years, the deduction that's available in the States is often substantially more than the Canadian one. The other thing to note is the Canadian depreciation is optional. So you can take anywhere between 0% and 100% of the maximum allowable. Whereas, as we discussed, the States, there's no option. You have to take the full amount. Typically for residential buildings, it's depreciated in the US over 27.5 years. In Canada, it's 2% in the year that you buy the property and 4% thereafter on a declining balance basis. So just to keep the math easy, if you bought a property in the States, well, in Canada, it wouldn't matter, at $100,000, your depreciation would be 2% in the first year, would be 98,000 after taking off the 2,000 of depreciation. Your next year, you'd have a deduction of 3920, which is 4% of 98%. And then you just take that off the 98,000. Then you take that amount off the 98,000 times 4% of that. So it's called a declining balance basis. Unlike the States, which is the same amount every year, just divided by 27.5. So what happens when the property is sold? If you sold it at more than you'll paid for it, then you'll be taxed on the net gain. Now, it's very important you keep good records of what you paid for it, as well as receipts for any improvements you made to the property over time, because those will increase your cost basis of the property, which means your gain will be less. So that's why you want to keep those records. And especially if it's a personal use property, you may have it for decades. You would need to file a US federal tax return at the very least to report that gain. If you owned it for personal use only, then you get the lower capital gains tax rate. However, if you rented the property out and claimed that depreciation, a portion of that gain would be taxable at a higher rate. Now, there's also the issue of withholding tax. That's because it's a cross-border issue. Because you're a foreign seller, the purchaser, regardless of where they're from, they have to hold back and send to the IRS 10% of the sale price. If you have the time, it's a good idea to apply for a withholding certificate, which means that they hold tax on the net basis, which would factor in what you paid for the property and therefore reduce the withholding quite a bit. A lot of people have heard about 1031 exchanges. 1031 exchanges allow an American resident to sell a property like a rental property, provided they replace it on a certain time frame. I believe it's within 6 months with a similar property. The capital gain on that first property is deferred into the second property, and you can keep doing that, doing that, and doing that, and doing that. Now, if you have a US entity, theoretically, you could take advantage of that. The problem is that only covers you in the States. It does not help you in Canada. So you'd have no tax in the States, but tax in Canada. Then when you sell it in the States, actually sell it, then of course you'd be taxed there, and you'd be taxed again in Canada. So you don't want that. There is an option for a specific type of trust that does similar things, the 1031 exchange, but it only applies for larger projects. So we're past, single homes at this point. We're looking at apartment buildings because you need to have at least $500,000 of gain before that becomes cost effective. Just to clear up, there's any confusion, people have heard of this replacement property clause in Canada. It specifically excludes rental properties. So it doesn't help. So how to choose a market? There's some fundamental things that you should look at when deciding where to invest. And it's important to remember, if it's not a vacation property for you, odds are you're never going to stay there. So don't choose it based on where you like to go. Choose it based on where other people like to go. So the first thing you're going to look for, though, is a place that has population growth. Then you have to see, is there also job growth? So if you have someplace warm, again, like Florida, definitely could be a lot of population growth, but if it's a bunch of retirees, they're coming down there and they're really looking to hold on to their money. They're not looking, to pay top dollar for a good place to live. However, people who are there because of jobs, entirely different story. So population growth must be accompanied by job growth. And then I would say that probably the most important thing, though, is this next one, which is it needs to be a landlord-friendly market. If you have a problem tenant, you don't want to be in California or New York, as an example, because you could go 8 to 12 months with no rent because you can't get them out very fast. Other states, say like Texas, like Tennessee, you're looking at probably 15 to 30 days and they're out. In terms of financing, obviously you can invest with cash. That's pretty straightforward. Home equity loans, a number of Canadians are doing that. So they're taking out a home equity loan on their property in Canada that has a lot of equity. And those are available at very low rates. And going down to the States with that, you could get a private loan. So if you, for instance, are able to get in touch with Americans who have retirement funds, in investment retirement account, or IRA as they call it, or a Roth IRA, which are similar to our RSPs and TFSAs in Canada, they're often not getting that much of a good return. So you could perhaps offer them, say, 8%, 6%. And they said, well, I'm getting 2 now. 6% sounds great. So private loan. Joint ventures, like we talked about, so you don't have to bring all the money. You could run the deal and manage the property manager and so on, and someone else could bring in funds. You can also work with loan brokers. There are loan brokers that are very much used to working with Canadians, and if that's something of interest to you, please send me an email and I can pass on 1 or 2 names. And there are cross-border bank loan opportunities, especially TD and RBC can be helpful. The third one is Bank of Montreal because they have a substantial presence through Harris Bank in the States. Now we've talked about the various categories of asset protection, creditors, inheritance, matrimonial property, probate. So that's just sort of a quick summary. Most cases it's going to be a capital gain situation, but you want to make sure that you understand how your sale of the property would be taxed before you go too far down the road. And it could help with estate planning. You also have to decide how much of that income you want to bring back each year or not. And there's withholding taxes. Foreign exchange, we're going to touch a bit more on that in a second. Obviously, regardless of whether you hold it through a corporation, a trust, or in your personal name, you must have a really good insurance policy. And you need to be aware of any tax or information return filings. So I just want to speak a bit more about foreign exchange. The timing of your transfer can increase or completely wipe out your profit depending on the swings in the value of the $2. So how do you plan around that? Well, if you can change the timing of moving funds, that can be very helpful. So if you have to bring back the money quickly, you're going to be at the mercy of how the dollars move. If you can decide, well, I'll bring it back when it's favorable to me, that's going to work out in your to your benefit. Something else to note, that whenever you're transferring significant funds, I'm not talking about a $1,000, $5,000 deposit, even 10,000. But when you start to pay for the whole property or a substantial down payment, you do need a foreign exchange trader. Why? Because they, of necessity, will offer a better exchange rate than the large banks. Because if the rates were not better, they wouldn't have any business. So that by necessity, you know their rates are going to be better than the banks. And if you need a referral on that, just contact me, because I have someone I can recommend there as well. So some of the key takeaways: if you're holding through a corporate structure foreign assets that have a cost of more than 100,000, you're going to have to report those on your tax return, with certain exceptions, like the vacation home we talked about. If the foreign income earned through a controlled foreign affiliate, so this is one where you and your family own 10% or more, sorry, you control it outright, then assuming that you pay at least 25% in income tax, no additional tax will be paid in Canada based on this FAPI or FAPI income. The CCC structure is recommended for Canadians with US real estate holdings in most cases, unless you're bringing back 100% of the income. Choose a market looking at population growth, job growth, and if they're landlord friendly. There's many financing options available. Our next event, December 30th. Hopefully some of you at least can make it then. I just want to keep up our regular routine. And I figured between New Year's and Christmas, a lot of people actually are around and do have some time, and it's not New Year's Day. So, or sorry, New Year's Eve. So hopefully some of you can make it at least. Again, it'll be 7 o'clock. And we'll send out the topic a little bit later. So if you have some specific questions that you want to go through in detail, I encourage you to book a session. There's the calendar link. And if you have any questions now, please Please ask.
Thanks, Michael. It's Sarah. Thank you so much. It was very informative. I just wanted to know whether we can have access to the video.
Yes, after a few days, I will post the video on my YouTube channel. And once it's available, I will send everyone in the group notice that it's available then. So yeah, you'll be able to see it in a few days.
Great. Thank you.
Okay, well, if there's no other questions, I guess we'll call it at that. A little bit over time, but I wanted to go through the parts we went through and slowly enough that you could actually absorb it. If you are looking to get some more information, please do contact me either through the email or set up a session. And I hope to see you on our next one. In the meantime, have a great holiday season. And if not, then we'll see you in the new year. Bye, everybody.
Michael. All right.